Good morning, ladies and gentlemen. Just as I knew that mathematics would make it go into risk on, I think it's precisely the wrong time. I think a little bit more pain in equities is coming over the course of the next couple of weeks before we have the potential for a rally into year end. And that is because monetary accommodation is being taken away, or the hope of monetary accommodation is being taken away from the market. And that is because of the wrecking ball of the US dollar. So let's examine what's happening in the bonds and the US dollar and why that is likely to suppress equities. Every single piece of data we got last week, from retail sales on Friday to the CPI and PPI the couple of days before, was basically hot. Even weekly claims were hot. Every single number is coming in hot. The US economy is basically on fire, and we've heard from various Fed governors now that probably they will not oppose a pause in December. Well, of course they won't. And also in December we get the dot plots. Well, what are they going to do with the dot plots? I would be very surprised if they don't hike them up by at least one, removing one cut in 2025. And the market needs to adjust. I think it's probably adjusted in the short end. I really like this 442 level in twos. I think it's, even if it goes above it to something like 452, it's likely to come back towards it. So if you buy 442 and average in at 453 for 452, you will make money because it'll come down. The problem is not in the twos, because the twos sooner or later are going to have positive carry, right? Where's the positive carry? It's around here, right? Because the Fed is 450, 475 even now. So it's very, very unlikely that the twos can go through that level. And I would have thought buying at 442 and averaging in all the way up there eventually makes money. So that's not what the problem is. The problem is that the yield curve is just so damn flat. If you have a look at 2s 10s, what are they? 11 basis points. And if you look at 5s 30s, and we have a look at 5s 30s, what is that? 25, or whatever that is, 20 or 30 basis points. So we have a yield curve which is so flat between the 2s and the 30s, and with the 30s at 460, it's 20 basis points throughout the yield curve gives you not all that much breathing room should the data turn even more hawkish. And I think that is, the odds are there that things which accelerate tend to accelerate further than people think it's possible. So if CPI and PPI don't come into line in December, what can the Fed do? They are on a preset course. Yes, they are going to ease as the data allows it, because the odds of them hiking are just about zero, right? So if the data comes in even worse, where is that going to reflect itself? Well, it has to reflect itself at the longer end. And therefore, I think that all the dangers always are in the steepening. To me, 2s 10s eventually break this level. They have to break it. And if we reset the price scale, we have to see where they are likely to go to. To me, they're always likely to go to this level where they were before the pandemic. And to me, at some stage, we trade minus 27 and possibly even, around this minus 41. We have to give it some time here for the moving average to come down, but any time it comes up to par, I think you really need to be a seller, because the steepening will take place at some stage over the course of the next 3 to 6 months. This is basically the real rate, the 10's real, and as you can see, we're at 210. We are now as restrictive as we were basically before the Fed started cutting. And we are likely to trade in this range for quite some time. 220 to 225 is where I see this topping out for the time being, but staying in that range for quite some time. And that is removal of monetary accommodation. And that props up the dollar. And don't forget that 50% of the earnings of S&P 500 companies come from abroad, which basically translate then in lower dollar earnings for those companies. So it's all tied together. The higher the real rate goes, the more restrictive real policy is, and we're getting there, right? We're getting towards those levels that I think it makes absolute sense to stay at. Now, 250 I thought was too far, 255, and we really came down very fast after that, because I don't think the economy can take 2.5 without slowing down. But obviously, you can take the 2 to 225 range quite easily. Every time we go below 2, the economy accelerates. And an acceleration of the economy, I don't think, is what the Fed needs right now. So I would have thought that we stay in this range, we go up maybe to 225, which basically tells me the yield curve at some stage steepens even more, as I showed you just now, because I don't think the short end can move. I don't think the twos can move more than 10, 15 basis points, and everything else has to come from the 10s and the 30s. So I really don't think that this monetary removal of accommodation, i.e. the tightness that the economy is going to feel, is going to go away any time before year end. I think if it happens, it's going to happen towards, quarter one sometime. I think quarter four is done. We're going to have a wonderful economy. It's going to be wonderfully strong, and bonds are not going to be able to rally. Compare and contrast that chart of US 2s to this chart of the Schatz. The Schatz is just not going up in yield at all. All week it stayed in a very narrow range, and I think that that is the way of things. The differentials are going out. 2s, 5s, 10s. The yield curve is steepening. This is where the steepening is showing itself up now. Okay, so this is 2s, 30s in Germany, and as you can see, the steepening just continues. It's a strong trend, and it makes sense. The steepening takes place in Europe first, because that is where the cuts need to happen. The steepening will take place later in the US, much later, probably, 2-3 months later in the US, and for the time being, the steepeners, as I've been telling you for quite some time, you have to put on in Europe, and only much later you have to have the steepeners in the US as well. For the time being, if you want to be long of bonds, the only place to be long of bonds is Europe. So now this is the differentials. This is 2s. So Schatz 2-year. I took profits too soon, but the fact that this is now turning all the moving averages tells me that this probably has some room to go up some more. Where are the levels? As you can see, 235 and then 254. Those are the levels. I would not be surprised if after, a few days of just buggering about here, we do try and make those ultimate levels. If we look at 5s, we're getting to levels that we've never really broken before. This 231 is a massive level, so that's another 15 basis points. And everything that these charts show is basically that the only way you can be long of bonds is to be long of European bonds, because the US bonds just will not perform for quite some time. They need to get the economy slowed down for the Fed to be able to continue the cuts and the steepening of the yield curve. So that takes time. So over the course of time, I expect, this 202 probably holds it a bit, and then it goes to this 220. The trend is there, right? That is the trend. We're going to go towards this 220 level between 2 and 220. And 220, I reckon, is definitely enough. So what it does, it allows the curve in the US to add on those 10, 15 basis points of yield, while the German curve, i.e. the German Bund, does nothing. But that is the trend, and that all tells you that the dips in the dollar are going to be shallow. And if the dips in the dollar are shallow, that puts more pressure on equities because, as I told you, their earnings in dollar translation are unlikely to meet expectations. I just wanted to show you this chart of the Italian bond just to show you what positive funding does. Okay, the Italian bond is trading 350, 360, and it has positive funding. And everyone is buying it over bunds, where the real problem is. I mean, the real problem is not in Italy. The real problem is in Germany in terms of the economy, industrial production, and so on. And let's have a look here at Italy, Germany. As you can see, it keeps on going down. That's because it has positive funding. These markets have all been starved of positive funding for a long time. And that's why I keep on telling you that the only way that the US is going to be able to get away those massive deficits that it has and it's planning to add to is if it has positive funding. And that means a steeper curve. You cannot have positive funding and have a negative curve or very flat curve. That doesn't happen. So just like this spread has come down over time in Europe because of positive funding, the spreads are going to come down in the US because of positive funding, and that necessarily means a steeper curve. That is the only way that I believe you are going to be able to fund those deficits and what Trump has in mind for the next couple of years. And that necessarily means that you have to look for spots to do 210s, 230s. That is just the way of the next few years. And lastly, for the CHS subscribers, this is September against December 2025. It's not going to go through this level anytime soon. It has to come back and fill and turn this moving average. So I suspect it's going to trade -9, -8 again, and then go in the first quarter. That will show you when the positive funding is likely to happen, right? The yield curve has to normalize and it has to go back to positive for positive funding to take place. I suspect that we will go beyond zero sometime in, I don't know, February, March. That will be the way of it. In the meantime, it's just going to trade in this range. And every time it drops down to here, you buy it. And every time it comes up to here, you sell it. But this is a great range to trade. 10 to 4, 6 basis points. You do a couple of hundred at each dot. It's great money because it's safe money. It will not go through here. The curve's direction is going to be towards positive. I'm absolutely convinced of it. The dollar is really driving everything at the moment. I got it wrong. I took my profits on 106.25. It went straight through, and it doesn't look like it's going to stop. I think every time it drops back towards this 106.25, you're supposed to buy call spreads or put spreads in Euro USD, because it's very, very unlikely that the dollar changes direction dramatically. As you saw, the data last week was really, really strong in the US and really, really weak in Europe. And the differentials keep on going, although they might not go more than another 10 or 15 basis points. It is what it is. Those differentials will keep on putting the pressure, upward pressure on the US dollar. We are at the top of the Bollinger Bands on the weeklies, and it doesn't like to go through it too much. As you can see, every time it's done it, it's come back. So that would tell me that we're in a range for the next 2 or 3 weeks, but I would have thought the trend by year end is going to be around 109 as a favorite to trade again. Probably not go through it, but that still puts the pressure on the dollar and the wrecking ball. And what does that do for euro? We are at major levels. It would make sense to have a bit of a bounce, but it's more likely than not that once we break this range, we add this range to the bottom. So we are going back towards par, back to 98 over the longer term. And that seems to be the way of things. And if that is the case, and we continue with the rapid appreciation of the US dollar, the US equities are really not going to like it all that much. The dollar basically spanked gold as well, just as much as anything else. So where is the natural bounce point is the 200-day moving average, which is around 2450. That would tell me that even if you get a bit of a pause in the dollar next week, you are unlikely to trade anywhere much above this kind of level, 2630, 2650, and then you get another leg down that takes you down to the 200-day moving average, and these levels that we traded, you can see that in the weeklies here. Anywhere below 2500, I would have thought is going to be a decent buy, especially close to 2400. That is going to be the natural bounce area where the dollar will probably be very tired and ready for consolidation and or retracement. So that is the area where I'd really like to buy it. I don't think we get there next week. I think it's going to take some time, probably 3-4 weeks of, couple of weeks of bouncing as the dollar stabilizes, and then the dollar has another move higher towards that 109, and that's probably when we can achieve this 2450 level in gold. To me, gold is probably going to do a B, C, come down here, and then that will be the level that probably you can buy it at. DBC is looking pretty ugly. It's right on the 2175 support. I just don't know about DBC. I would avoid it completely. I think these markets are just not healthy. Commodities are really not all that healthy at the moment. If you look at the components like oil, it really doesn't look good, does it? It just cannot sustain any rally above 70. I would have thought that at some stage it's going to go and break down and get, stop all these people out. And that is by going down to below 60. That's the, just below 60. And then where can it go once it's gone below 60? I think it can easily go to this kind of level. And that is around, sort of 54. That would not surprise me in the slightest if it happened. And that would actually support bonds and might actually even get the Fed to ease over time and give us that steeper yield curve. So to me, there is absolutely no reason at the moment to hold commodities. And I'm not a bull of it. I just don't see how that is going to be the problem for bonds. It just isn't. And Finally, the copper chart also looks ugly, and I think it can easily come down and trade around this 3.5 level easily. So all these commodities are looking pretty deflationary to me, and that is why I think it's too early to buy gold, and that is why I just will not buy commodities for the time being. I just don't see any reason to. The charts are telling me to wait, and wait quite a long time. Let's start with the clean chart, and I think that this is actually quite telling. We've closed on Friday just on top of the level that I think is quite important for the time being, which tells me that we are going to oscillate here, but sooner or later we are going to take out this whole gap of the election night, and that we are also going to stop out everybody who bought up here. And that to me takes it back down to 56.75, something like that, and that's going to be enough for a monster bounce. The problem is that a 2% move from the highs just is not enough to stop anyone out. And the background is not great for equities. We have the removal of monetary accommodation in the US. We have a steepening which will come but is not coming yet. And therefore, equities are just not in a position to start powering ahead. When equities are not in a position to power ahead, they are more likely than not to stop people out. Now, we could just go and move sideways for a week or so, but I think that that is unlikely, especially because the chart of volatility tells me that at some stage we get volatility, and that tends to stop people out. Now, I'm not bearish equities, don't get me wrong. I think that at some level, and it might be even here, 57.60, they're a great buy. But I just can't see them making new highs at the moment. I think they need to stop everyone out and then go. The US economy is doing great, and I don't think it's going to slow down over the course of a month. So this isn't going to be something that I think is going to happen, immediately in terms of going down. I think this is going to be a trading range that slowly gets people's enthusiasm out of the way and stops them out. And of course, Nvidia is going to be a big factor in that. And let's have a look at the NQ chart, and why also I think that it's very unlikely that the SPX can move very far, very fast, simply because tech is not leading. So here we have my 195-minute chart, so basically 2 bars to a day, to a trading day. And if we enlarge this, we can just see that the slope of the is just not what it used to be, is it? This is what it used to be when, you get a strong bounce, and now we're getting nothing. To me, this 19,900 level is going to be very, very important. And I think that even if Nvidia earnings are not bad, which is the highest likelihood to me is that Nvidia slightly beats on both earnings per share and also on revenue. And then it'll be interesting to see the market response. And I think that if it's even a small beat, they sell it. And then where does the market go? The market goes to this level, 19,900, and basically then just sort of tries to stop out all the people who are long up here, and might even come down and fill this gap, and why not 19,300. And then, this is the 200-day moving average. It's still pointing upwards. It's not the 200-day, it's the 200 period. But, it just slowly bleeds everyone to death and then makes up. And having bled everyone to death, it's then ready to make another move higher into the end of the year. Whether it sustains it or not is neither here nor there. But what I see ahead is removal of monetary accommodation. The fact that the US dollar is strong and is basically reducing the earnings. Bonds not being able to rally at the long end because they don't have positive carry. And that tells me that the multiplier isn't, the market is not going to get any help from the long end of the bond market. And therefore, it's very unlikely that assets can rally over the course of the next couple of weeks. Gold still hasn't done what it needs to do. Probably the dollar hasn't done everything it needs to do. And therefore, buying assets right here and right now, to me, makes very little sense. And you have very little in terms of risk-reward of doing it now. Doing it when the market has been stopped out of its positions makes far more sense. And US equities are also being weighed down by what the foreign equities are doing. Now, this is the stocks. And as you can see, it keeps on trading below the 200-day moving average. What it's not telling me is that it's not going to go a million miles to the downside. But I would have thought that, trading just above these levels of 4650 to 4700 is where it's likely to go and have some goes at these lower levels. I think these lower levels are buys. But while the foreign markets, and that here I count Nikkei as well, all trade below the 200-day moving average, it's very unlikely that the US market can just power ahead. And that tells me that these markets are tired. Look at EEM. It's definitely going to come and trade 42.25. It's probably going to go even lower and trade, the lower Bollinger Bands around 41. I think these levels are going to be buys into year end. But all these foreign markets are telling me the same story. Now, they're getting hit more by the dollar than the SPX or the NASDAQ. But when such a large proportion of the earnings of the US companies is from the rest of the world and it's in the local currency and no way do they have it all hedged, you have to expect lower earnings. And while the bonds can't make any headway because the economy is so strong and they don't have positive carry and the Fed is unlikely to move in December, that all tells me it all triangulates the same way. At best, we go sideways, and at worst, we start stopping people out in equities, which actually would be healthy for next year. Let's finally look at the VIX chart. And I've said for a couple of weeks now that I think it pushes the downside and then it comes and fills this gap. And I think equities will probably be a decent buy or on a risk reward when that happens. I don't think it's going to happen necessarily next week, but over the course of a few weeks, I see at least 18.5 trading, if not 19, to the 20s and a complete gap fill. It will happen, and that will be the best time, or the best time I can guess now, to actually start buying equities again, probably for a year-end rally or for next year. But I'm pretty convinced that this gap gets filled, just as I showed you that I'm pretty convinced that the gap in the election gap gets filled in SPX, and that those will be decent times to nibble at equities. Basically, to summarize, I think it's too early to buy anything. I think more pain needs to be inflicted, and probably especially in the DXY and DBC and gold, more pain is needed before these are buy levels, and equities I'm just not bullish now. Now, whether it's 5,800 or 5,765, there will be wonderful bounce opportunities, but I don't think you have to rush in and buy them now. It's just not going to happen, and especially since next week is so data light, and really the event of the week is the Nvidia earnings, which are going to move the indices the most, I would have thought. You really want to wait and see the market response, because if the earnings, as I said, are slight beats on both, and the market still goes down, that tells you that I'm right. And all these factors like monetary accommodation removal and the fact that the yield curve isn't moving, isn't steepening now, all that tells you that there will be more pain for all assets as the market tries to stop everyone out before it can make its move higher again next year. Thank you very much indeed, and tweet you tomorrow.